Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 15th, 2025. I hope you're doing well. I appreciate you tuning into my weekend review podcast. I hope you're going to find it helpful. We had quite the week. We've actually had quite the last few weeks, but last week really was it was vicious. It was vicious. But I hung in there. I had some good trades. I was fortunate in that respect, and I'll be showing you all those today. But I do want to say right at the top of the podcast that we certainly are in deep dip buy area. I think that people that are panicking right here, they may be panicking at the wrong moment, and I'll kind of make my case as far as why, from a technical standpoint, of why we may be in a bottoming process, especially upon the price action on Friday. So I hope you're all doing okay. I hope you're staying safe. This is real trading. This is serious stuff that we're going through right here. Many times I hear traders talk about how trading is so easy, and it certainly is not easy. It is when you just go up and up and up and you never go down. But we are in a serious pullback, a serious correction. But hopefully, in today's podcast, I'll give you some ideas and at least my opinion on why we may be in a bottoming process. So, again, thanks for coming by. I hope it's going to be helpful. The format today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we are going to come back. We're going to take a look at all the trades I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the strategy was, what the confluence of signals were of why I took the trade, how I'm going to place my emergency stops, how I'm going to place my end of stops, how I'm going to take partial profits if the market moves my way, and basically how I'm just going to manage the trades going forward. So when I entered, why I entered, and how I am going to manage the trades going forward. I say this every weekend when I do this podcast, but everyone, you got to get yourself a process. So you know exactly what you're going to do regardless of what the market does. If it's just up to you, um, to make your entry and exit decisions based upon some kind of impulsive thought or the last thing you saw on the internet or CNBC, that's not the way to do it. You need to have a process, and that's what I try to teach you in this weekend review, and also what I teach my individual students as well. So after we take a look at all my positions, and like I said, well, I had some new entries on Friday. I got out of some that I stopped out on. Some are doing well, and I'll show you how I'm going to manage that. But when we're done with all that, we're going to talk a little bit about trader psychology. Trader psychology never as important as it is at this moment. And really, what trader psychology ultimately comes down to is setting your plan, having a plan before you go into the trade. And once you enter the trade, sticking to your process. That's really what it's about. When you boil it all down, that's really what it's about. So I always enjoy teaching trading psychology, and I hope you're going to find it helpful as well. After that, I have gone down through my watch list. I go down through the watch list every Friday night, both on the daily time frames and the weekly time frames, and I identify some potential trades for the upcoming week that I am interested in possibly entering, if and only if they get to the levels that I need them to get to, which at this moment are certainly deep dip buy levels, bullish order block levels, and ideally, if they come together at the same time. If you have a confluence of signals right now, everything I'm looking at is confluence of order blocks and deep dip buys at the same time. So gives you an idea of kind of how I look at trading, how I look at potential setups for the next week. But I need to let those setups or that price action come down to the setups and show me some kind of reaction to show that those levels are holding. Then, it may potentially take the trade. But once I take the trade, I need to know exactly what I'm going to do, right? Position size correctly based upon volatility, know where my emergency stop is, know where my end of bar stop is. and then how to manage the trade if it goes my way, right? That's the ultimate goal. So you need to know what to do to the upside as well. So if you find any value in the podcast today, I really would appreciate it if you could hit the thumbs up button. It helps the channel out a lot. If you haven't subscribed and you'd like to subscribe, I would really appreciate that as well. Helps build the channel, helps YouTube know that there's some valuable content here. All right, so before we get started on the charts, let's run this U.S. legal disclaimer, get that out of the way, and then we'll get rolling. Hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get rolling. So I have quite a few positions that I entered and exited this week. So hopefully this is going to be a good example so you can see multiple signals, both winners and losers. I did enter Apple on Friday, and I entered it on Friday yesterday at 213.50. This is a really good setup. I mean, it could be better, that we could have a few other price action and indicator things going on that would make this a better trade. But all in all, this is a really good trade. Now, it doesn't mean that it's going to be a profitable trade, but going into it, the setup's there, and that's why I took it. So this is a combination of a deep dip buy and also a combination of a bullish order block. And if you've been watching the channel for a while, you know order blocks are very important to me, very strong signals. But let's take a look first at the deep dip buy. Well, this is a perfect deep dip buy. And the previous day we closed under the 300-day moving average. Remember, deep dip buy involves the 200-day moving average, the 250-day moving average, the 300-day moving average, and the 30 RSI. Any one of those by themselves is a legitimate signal, but it's a better signal if they happen at the same time. And this happened at the same time on Friday. The previous day we closed below the 300-day, and then you can see Friday we closed above it. By itself, it's a legitimate signal. But we also, on the RSI, the previous day we closed below the 30 RSI, and we closed above the 30 RSI on Friday. So we got them both. And that's a very strong signal. Doesn't mean it has to work, but it is historically and backtested a very strong signal. So on the deep dip buy, we had to close under, close over the 300-day moving average, and we had to close under, close over the 30 RSI at the same day. Now, overlaying on top of that, you can see this order block, this block of green here on my screen. What is that? Well, an order block is simply your lowest bar close. This happened back here on August 6th. Your lowest bar close before you change market structure to the upside. Here we change market structure to the upside. And it danced around a little bit, but you can see, it really did. So you take the high and the low of the order block. You look at market structure change, you look back and you see the order block. It's the high and the low of the order block. That goes out into the future. And many times when you get back into the order block, even if it's a year later, 6 months later, 9 months later, a year later, that order block holds some general type of support. So you can see on Friday, not only did we have the under 300 close over 300, under 30 RSI close over 300, over the 30 RSI, but we also rejected the order block. Technically, you could have taken this trade on Apple on Thursday when it rejected the top of the order block. But I remember thinking about this, and I took another trade that looked better instead. But so this is what we have. We have a rejection of the order block all the way back from August 24, close under, close over 300 day, close under, close over the 30 RSI. I could not not take the signal, right? I mean, you wait for these to come along, and it came along. So I did get long 213.50 on Friday. Now, the when I get long, I won't do this on every position. I'll just do it on the first one here. But the first thing is I need to know how to position size, because right now the market is very volatile. When the market's very volatile, you need to buy fewer shares. So how do you do that? Well, you'd have to take into account how much money do you have in your trading account and what is the value of the 2 ATR. When the 2 ATR is larger, you're going to buy fewer shares, and I'll show you the math. So let's just use 1%. Let's say we have a $100,000 trading account. We use 1%. If it's a $50,000 trading account, it's $500. If it's a $100,000 trading account, it's $1,000. $200,000 trading account, $2,000. You get the idea, right? So let's use the $100,000 trading account. 100,000 times 1% is 1,000. Then I simply take that 1,000. I look at the value of the 2 ATR right now, which is 12.79. So for me, in the way I trade, the proper position size to buy for how much money I have in my account and the current volatility is 78 shares. All right. So I have my signal. I have the under over 300. I have the under over 30 RSI. I have the rejection, the bullish order block, and I make my trade. I buy 78 shares at 23.15. Now, the first thing I do after I enter the trade, always the first thing, is I look back at the ATR. Remember, it was 12.79. We did the math on 12.79. I take my entry price minus the value of the 2 ATR, and I put a solid red line down here. What is that? That is my emergency stop, right? That's my emergency stop. So if I have, how many shares do we have? Oops, sorry. So if I have 78 shares and it moves $12.79, how much have I lost? I've lost $1,000 because we just did the math. That's 1% of my account. Now, that only happens about 5% of the time, but it happens. I'm going to show you. I had a trade last week where that happens. But 95% of the time, fortunately, you're going to lose much less than that, and that's your end of bar stop. So the emergency stop is 2 ATRs below. In the coming week, if it ever got there, I would just get out. I don't wait for the end of the day. If it gets there, I said, okay, I'm willing to lose 1% of my account on any one trade. And if it gets there, you just have to get out immediately. The other stops, the end of bar stops, are based upon the close. All my closing or my entry prices when I enter a trade is based upon the close of the day, right before the market closes. My exits for my end of day stop are based upon right before the close, right? But the emergency stop is always immediate, whether that's 1 second after the market opens or 1 second below the market or before the market closes, I get out. Everything else is based upon the price right before the close of the market. So I have my entry price. I put my emergency stop 2 ATRs below. Now I have to decide what is going to be my end of bar stop. Well, I could go at it a couple different ways, but for me, we rejected the 300-day moving average. It's a very good risk to reward ratio. So if the market closes below the 300-day moving average, even by 1 penny on Monday, I'm simply out of the trade. I can get back in the coming days if it closes back above. Does that make sense? So that's the trade. Under over 300, under over 30 RSI. We also have the confluence of the order block. I position size based upon the volatility. As I just showed you, 1% of your capital divided by the value of the 2 ATR on that day. Place my emergency stop, that value below my entry. As I've just mentioned, my end of day stop is a close below the 300-day moving average. So everything I've talked about so far is, oh, sorry, one more thing. So, and then I'll get to that. So I have my entry price here at 213.50. The next thing I do, once I know where my emergency stop and my end of bar stop is, I take my entry price, then I look for the value of the 1.5 ATR. Right now, the value of the 1.5 ATR is $9.59. Why is that important? Well, I take my entry price, I add $9.59, I put the line up here. This is my trailing stop level. If in the coming days or weeks I get up to this level, then that tells me to go into trailing stop mode, which is just another way of telling me I've moved enough from my entry now that I can start to tighten up my stop. And I'll show you this on some other trades that I have this week. But it's very important to do this, because once you move 1.5 ATRs from your entry, once you moved outside of the noise, then you don't want to give it all back, and you want to have some rules that you use to tell you to get out of a portion. So as a matter of fact, when I get to trailing stop level, now going forward in the future, if I have a close below a previous bar's low, I'm going to exit half as a precautionary measure. If I exit half and it keeps going up, I'm still glad that I have half. If I exit half and it goes all the way back to my entry price or lower, I'm glad that I sold half. Makes sense? So it's really one of the only win-wins in trading is taking off the half. Okay, so now everything I've shown you as far as the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive moves. These are all actions that I take if the price goes against me. So now let's talk about if the price goes my way. So I take partial profits if we move the value of 0.45 ATRs from the closing price. So I just entered this. I'll show you exactly how I do this. So I take the closing price of the day on Friday, 213.49. Then I locate the 0.45 ATR value. Right now it's 288. Okay, so these are exactly the orders that I'll put into my account come Monday. I take the closing price, 213.49. I look at the 0.45 value, which is 288, and I add them together, plus 2.88. Okay, my first profit target is 216.37. So I'll just put a line here to show you. 216.37. That is my first profit target for Monday, is 216.37. Now I do it one more time. I take my first profit target, 216.37, and I add the 288 to it again. My second profit target for Monday is 219.25. So I go here, 219.25. That is my second profit target, and I do it one more time. Take the second profit, 219.25, add the value of the 0.45 to it, 288 again, 222.13. $222.13. So now I have 3 profit targets for Monday. So what do I do with those? Well, I will take off 10% of however many shares I went into the day at. What was our what was the amount of shares we were buying? I guess we'll do it again so we know exactly. So 1,000 divided by 1279, 78 shares. Okay, so if I go into this trade with 78 shares, how many shares do I get out? 10% at each intraday profit target. So 10% of 78 is 7.8 shares. So I would put a limit order in for, I'll round up, obviously, 8 shares at 216.37, 8 shares at 219.25, and 8 shares at 22.13. If it goes down and closes below the 300, well, then I'm out of the trade and I haven't hit any profit targets. But if we bounce a little, maybe I hit 1 profit target, maybe I hit 2. If I have a really good day, I hit 3. If I have a great day, I hit 4 or 5 or 6. I've done that before, but I don't put 6 or 7 profit targets in because it's so unlikely to happen. 3 is about what's likely to happen in any given day. If it goes higher, then I just have to do them manually. So I really like taking partial profits because I'm selling into strength. That's the offensive part. And as we go through other trades today, you'll see the profit targets I took and so forth. But so right now, it's basically even. I bought right at the close. But again, deep dip buy in combination with the bullish order block. And really, these are some of my favorite setups. And this is one of the reasons why I'm thinking we may be at a short-term low and ready to bounce, because a lot of markets have rejected their order blocks. They have had confluences of deep dip buys. So we'll see what happens. If we close below the 300-day moving average on Friday, I'm simply out of the trade. If we move up, I take partial profits if it moves enough. Once I get to trailing stop mode, then if I have a close below a previous bar's low, I'm going to exit half. If we go down and crash and we get to my emergency stop, what do? I get out. So see, I have a plan. I don't care what it does. I know exactly what I'm going to do. And that's what I suggest for you in your trading, that you get a plan, that you know exactly what to do. If this happens, I'm going to do that. If that happens, I'm going to do this. And I teach private one-on-one lessons. I teach my students, like I said, one-on-one, all 7 of the different trading approaches and strategies that I use. I'd love to have you as a student. I'll teach you everything I know from all my experience of trading almost 30 years now. And I teach everything I know. But if you don't get it from me, if you don't become a student of mine, get it somewhere. The main thing that matters is that you find a process and then you follow it. Okay, so that's Apple, just about even on Apple because I bought it right at the end of the day, but we'll see what happens. That's a strong signal. Okay, let's go over to the next trade, IBB, and I'll be a lot faster on this particular trade. So IBB, you see this red block up here? Well, this is an order block also, but it is a bearish order block. What makes it a bearish order block? Your highest up bar before market change to the downside. Now I'll be looking to short if it rejects the order block. And so I did get short here on the 21st of February at 138.90 because 1, it rejected the bottom of the order block. 2, it rejected the 200-day moving average. 3, we had a bearish V1 to the downside. So like I said, I got short here, 138.90, placed my emergency stop 2 ATRs as always. My end of bar stop is simply a close above the high of the order block, 142.60. I place my 1.5 ATR trailing stop level, 1.5 ATRs below my entry because I'm short. And then if it moves down, I take partial profits. So the next day didn't do much. Next day moved down, I hit some profit targets. The next day it moved down, hit some profit targets. Next day moved down again, hit more profit targets. Next day we get to trailing stop level, which now means going ahead in the future, if I have a close above a previous bar's high, because I'm short, I will exit half. Well, we opened up, had a huge day down. I took more profit targets. Next day down again, took some more profit targets. Next day here was our first close above a previous bar's high after reaching trailing stop level. I exited half of my short position for a gain of 2.32%. Then we rallied for a couple days, no profit targets, and then next day we opened lower. I hit some more profit targets. Here on the 11th, I think I hit 3 profit targets because it was such a big down move. So do you see how I'm taking off my positions, locking in those profit targets intraday and reducing my position size in case we have a rally? Next day didn't do anything. Thursday, we were down again. I took some more. I covered some more shorts, right? I covered some more shares on the short side. And now we were up on Friday. So this has been a really good trade. I mean, it's been an excellent trade. And taking the partial profits when the market really sold off was great. So the remaining shares that I have up 3.27% on the short. Now, if we go lower and we get to a 35 RSI level, then the 5 EMA comes into play And if it gets there and we close above the 5 EMA, I'm simply out of the trade. Conversely, if we go down more and reject the 30 RSI, I would take off half of the shares. And then to get out of the remaining shares, if we had a close above a previous bar's high, after rejecting the 30 RSI, then I'd be totally out of the trade. And I know it sounds complicated if you're new to this, but they're just rules. And once you understand these rules, you won't even have to think about them. They're just obvious to you. Again, that's what I teach in my lessons. I want to give a shout out to Stephen and Pete, currently teaching both of them, and it's a good environment. It's a good environment, especially to learn deep dip buys, because it's exactly what we're in right now. So the remaining shares on this short up 3.27%. All right, let's go to Baba, Alibaba. This is a different approach, different strategy. This is called an abandoned baby, a bearish abandoned baby. There's such thing as a bearish abandoned baby. There's such thing as bullish abandoned babies. And if you go to my YouTube channel and just type in abandoned babies, you will see I did a video there kind of explaining in detail. But essentially what an abandoned baby is when you get a strong, a bearish abandoned baby is if you get a strong move up, you get a gap up. So here on the 20th, then the 21st, we gapped way up. So there was obviously some good news, some good market sentiment. However, the next day was immediate gap down. So when you have these rapid bullish to bearish moves with these gaps, more times than not, if you look out into the future, this price is going to be lower. Conversely, if you have a gap down followed by a gap up, that's bullish. More times than not, you look out into the future, you're going to have the market be higher. So when you have these bearish babies, this is, I'm looking for a short position. So do I enter as soon as they happen? You can. Obviously you can, but what I like to do is after, in this particular case, when you have a gap up, gap down, I like to look for a little bit of a rally and look for the price to reject the bottom of the baby. You see how this price here rejected the bottom of the baby? And that's where I got short, 139.20. Now with this particular strategy, this one's very simplified. I don't phase out of this one, take partial profits. It's a very simple strategy on where I get out for a loss and where I get out for a gain. And what I do is I place my emergency stop 2 ATRs above, like on all trades. So 2 ATR stop above, but then I put a 4 ATR profit target to the downside. So if I'm right, I lose 2 ATRs, or in other words, I lose 1%. If I'm right, if I'm wrong, I lose 2 ATRs or I lose 1%. If I'm right, I make 4 ATRs compared to losing 2 ATRs. And that's proper trading. That's proper risk to reward. If I'm right, I'm going to make twice as much as if I'm wrong. And you need to have that in trading. You need to have these asymmetrical risk to reward ratios. And based upon my experience in my trading, when these happen, you're much more likely to hit your 4 ATR profit target than you are your 2 ATR stop. So if you back test this, and even if it was 50% of the time, right? 50% of the time I make 4 ATRs, 50% of the time I lose 2 ATRs. Well, yeah, I do that all day long. That's like flipping a coin with your friend, and when you win $2. And if you lose, you pay $1. You do that all day long, right? Well, this is exactly the same thinking with this particular type of trade. But I wait for the price action to show me that, because we gapped up and then we gapped down, more likely than not in the future, this is going to be lower, and therefore the 2 ATR stop, the 4 ATR profit target. So it started off really good, went down, but it's been strong. It's been strong, and currently this particular trade is down 1.28%. So not bad. Alibaba is very strong into the sell-off that we've had in the U.S. market. But like I said, I'm either going to hit the 2 ATR stop or I'm going to hit the 4 ATR profit target. It's kind of nice. It's a set it and forget it trade. All right, so down 1.28% on Alibaba. Let's go to Intel. Well, Intel was a big, Intel was a big trade for me. If you watched the podcast last week, I told you I was looking for a level on Intel, a bullish order block within a bullish order block. The bigger order block here is in the blue. And anytime we've gotten into this blue area, if you've been watching the channel for months, you'll see that I have taken this trade many, many times on Intel. Let's define the order block. Back here on the 7th of August was our lowest bar close before we change market structure to the upside. Therefore, anytime you get back into the bullish order block, it's generally a good place to buy. And it was, and it was, and it was, right? I took all those trades, and I also took the trade on the 11th of March here. I bought at 1977. Why did I buy there? Okay, so first of all, we have the bigger order block. That's the high and the low of the order block from way back then, right? But then we have a new order block. See the green box? Again, it's your lowest bar close before it changed market structure. So we have an order block within an order block. And last week on the podcast, I said, if we come down and we reject for one, we're already in the long-term order block. But two, if we reject the high of the new order block that's within the order block, I'm gonna buy here, right? Because Intel has been very good to me every time we've come back into this price. And that's what happened. You can see on the 11th, we rejected the top of the order block that was already in the order block. So I got long here at 1977. I position size correctly, placed my emergency stop 2 ATRs below, and where was my stop? It was just a close below the low of the order block. That was it. Placed my 1.5 ATR trailing stop level above, and next day opened up really strong. I hit some multiple profit targets. The next day here was a massive move up. I think I hit 5 profit targets on this day. Clearly we're in trailing stop mode now. So now I'm in trailing stop mode. And all that means is going forward, for example, on Monday, if we close below this low, Friday's low, I would exit half. If it just keeps moving up, I'll continue to take profit targets. We're at a 59.28 RSI. If we get to the 65 RSI, then the 5 EMA will come in for the trailing stop level. If we get up to the 70 RSI levels, then those are areas for me to completely take off the trade. So really good trade. Very lucky to have this trade. They had news. I mean, that's why it went up, but I'll take it. And this particular trade at the moment up 17.8%, which is great on a week like this. So, if you'd like to learn more about order blocks, I'll teach you one-on-one. I've taught many people from all over the world, and they're a good thing to know. So this, the remaining shares after the profit target on Intel up 17.8%. AMD. Okay, AMD is a combination of a deep dip buy and an order block. You can see the green box here is an order block way back from, oh my gosh, how long does it go back? All the way back here from 2023. And then it rallied from the order block. It's finally come back down into the order block. So this is a combination of a bullish order block and a deep dip buy. Why a deep dip buy? Well, this is simply a close over the 30 RSI while you're in the order block. And in addition to that, we have this channel line where I take the swing low here, the swing low here. I run those out into space, and this all converged at this point. So on April 4th, I took the trade because, one, we went under the 30 RSI, over the 30 RSI. We went under the trend line channel. We closed over the trend line channel. And again, it all happened in the bullish order block. So I got long at $100.50. I placed my emergency stop 2 ATRs below. On this particular trade, My stop was simply a close below this trend line. You can see it has not happened. Entered, it came back on me, but you see how we just held that trend line the entire time? So finally, this trade has gone positive. Grateful for that. It is up approximately 0.55%, so about a half of a percent, but it's up, which is saying something in this week. And then, of course, this orange line up here, what is that? That is my trailing stop level. If I go into, if it gets there, then I'll go into trailing stop mode. Okay, so that is AMD. Let's go to Caterpillar. Caterpillar have a lot of positions. So Caterpillar, I did enter Caterpillar here on the 4th of March. Why? Rejection again of the order block. You see the green block here? Do you see how on the day I entered it, we went below the low, but then closed above the low? That's a rejection of the bottom of the order block. I got long here, 326.70. My position size, as always, using the 2 ATR. I place my emergency stop 2 ATRs below. As always, where's my end of our stop? Just simply a close below the order block. You see how close my risk to reward ratio was? Next day, if it closed down 20 cents, I'd be out of the trade. But fortunately, it went up. The next day went up. Next day it went up nicely. I hit some profit targets. The next day we got into trailing stop mode. Next day up again, took more profit targets. Now I'm in trailing stop mode. So here on the 11th, we closed below a previous bar's low after reaching trailing stop level. I took off half, right? That's the process. That's what I do. And I took off half for a gain of 3.81%. And then we had a couple more days down, and then we were up again on Friday, and it's almost exactly the same price as where I got out. So I took off half for 381, and roughly the remaining half up 383. So really grateful for some profitable trades, especially on this type of week. So that's Caterpillar. Okay, we're almost done with the open positions. This is Amazon. I bought Amazon here on the 10th of March. Why? Pretty simple. You see the green box, that's an order block. And not only did we reject the top of the order block, but we also rejected the 300-day moving average. I got long 194.60. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop, simply a close below the 300 because it's the best risk to reward. It's the closest. Placed my 1.5 ATR trailing stop level above. And the next day, moved up, hit a profit target. Next day, closed down, no profit targets. Thursday, of course, was down again. And then we were up on Friday where I did take one profit target. So this particular trade currently up 1.8%. And then last but not least, I did get long DIA, which is the Dow Jones Industrial. I got long on Friday. Really good setup. Doesn't mean it has to work, but it is an excellent, not Friday, Thursday, excuse me. I got long. Why? On DIA. One, we're in the bullish order block. Two, we rejected the 300-day moving average in the order block. You see how intraday we went below, but yet we closed back above. That's called an intraday rejection of the 300-day moving average. By itself, it's a legitimate trade, but in conjunction with being inside the bullish order block makes it even better. So I position size, enter 408.90. I place my emergency stop 2 ATRs below. My end of bar stop is just simply a close below that 300. The next day, if it closed below 1 penny, I'm out. But just happened to get it at the right price. Thankfully, you can see the orange line up here is my trailing stop level. And then on Friday, of course, we had a big day up. I hit multiple profit targets. We went under 30, over 30. Not that it mattered for my trade, but it helps. So the one-day trade here on DIA, grateful for that because that is up 1.53% on the first day. So that's DIA. Is that all of them? Yes, it is. So just quick recap. Apple, current position, right about even because I took it on Friday. IBB, the remaining shares on the short, up 3.27%. Alibaba, the short position on the abandoned baby, down 1.28%. Intel, up 17.8% with the order block within the order block. AMD, currently up 0.55% on the deep dip buy in the order block. Caterpillar, the remaining shares I have, up 3.83 based upon the rejection of the order block. Amazon, the combination of the bullish order block and the deep dip buy, currently up 1.8%. And DIA, which I just went over that I bought on Thursday with combination of the deep dip buy and the rejection of the 300-day moving average. So those are the open positions. And now quickly, let's go into positions that I closed and we'll talk about that. So this is one of the worst trades I've had in a while, but I went into it with a really good setup, which goes to show you that just because they're good setups do not mean they have to work. I got long here on the SPY on the 7th of March with a great setup. We had a intraday rejection of the 200-day moving average. We had a V1. We had a rejection of the negative third ATR channel. I mean, I would take this trade every single time it came up. I got long 575.40. Position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stops a close below the 200-day moving average. And look what happened the next day. We just got right to the emergency stop, and I just simply had to get out of the trade for a loss of 3.03%. So does that mean I lost 3.03% of my account? No. I only lost 1%. Remember, because we took 1% of the capital divided by the value of the 2 ATR. So if it gets there, I know I lose 1%, and that's all I was willing to risk on the trade, but it got there. So you don't see it hit the emergency stop many times. Like I said, in my experience, it's about 5% of the time, but it did get there, and I had to get out. Then the next day it went down, and then it went up, and then Thursday it was down, and I was glad, and now I'm up, but it doesn't matter because I have a lot of positions. But it just goes to show you this is a A-rated entry signal that failed. So I don't care if you have a triple A rated, it can still fail. That's why you have to put your emergency stop in. So a loss on SPY of 3.03%. Let's go to VIX. Well, VIX was a monster trade for me. And again, why did I take the trade? I got long VIX all the way back here on the 20th of February at 41.40. Why? Because we came back down into the bullish order block, created a V1 entry. I got long 41.40. I placed my 1.5 ATR trailing stop above. Next day, blast off. Hit multiple profit targets. Next day, got to trailing stop level. Now, if I have a close below a previous bar's low, I'm going to get out of half. Next day, up again, more profit targets. Next day came down but did not close below the low, so I did not get out of half. Next day, up again, more profit targets. Next day, up again, more profit targets. Next day, huge up day where I hit multiple profit targets. Now, here on the 4th of March, I exited half of the position. Why? Well, on this particular day, during the day, we went above the 70 RSI, and then we closed below the 70 RSI. So my deep dip buy rules are that if I'm long and it goes above 70 RSI and then closes below 70 RSI, I have to get out half, and I did. So I took off half of the profit at $18 or 18.07% profit. Half, pretty good, but was not over. Then the next day we went down, no profit targets, but then right back up the next day where I hit multiple profit targets. Then the next day we went up. I can't remember if I hit one here. We reversed. The next day we went up again. I hit multiple profit targets again. And then the very last day, I took off another profit target right near the top. And the rules are if you reject the 70 RSI, then the next time in the future, if you have a close below a previous bar's low, I exit the entire, the remaining position. It's exactly what I did here on the 12th. So I exited the remaining shares that I had on VIX on the 12th because we closed below a previous bar's low after rejecting the 70 RSI level for a gain of 23.93%. And then the next day it went up. I was like, oh, I guess VIX has more, and then we've come down. So this is one of the reasons why I think we may have put in a short-term bottom, because VIX, if you watch VIX carefully, if it starts to go down strongly, then obviously the market's more likely than not to go up. So anyway, when I get into the indexes of trying to make my point of why it's likely we're at a short-term bottom, we'll get back to the VIX. So the remaining shares on VIX I sold for a gain of 23.93. And then Google, I did get long back here on the 3rd of March. Why? Nice combination of 1, being in the order block, and 2, rejecting the 300-day moving average. In the order block, I got long 167.20, emergency stop 2 ATRs below. End of bar stop, closed below the 300-day moving average, placed my 1.5 ATR trailing stop level above. Next day, up strongly, hit multiple profit targets. Next day, hit 1 profit target. Next day, no profit targets, but we did get to trailing stop level. And then look what happened here on the 10th. I'm in trailing stop mode, but we closed below my initial end of our stop. So I had to get out of the trade. Does that make sense? So let's see. Yeah, for a loss of about 0.84%. So not bad on the loss, 0.84%, but yet this loss was mitigated because remember, I did hit some profit targets while the stock was going up as well. But you see on this day, we closed below the 300-day moving average. Not a big loss, and I can always get back in the trade. And right now, we are under the 300-day moving average. We're still in the order block. We rejected the bottom of the order block, which is good. So if Google can get above the 300 next week, I could re-enter the trade. So this was a loss of 0.84%. So the closed trades had a loss of 3.03% on the SPY. The remaining shares on VIX, I had a gain of 23.93%, and Google a loss of 0.84%. But what's important here with my trades, if they're winning trades, you're going to see larger percentages. But on the losing trades, if I'm doing my job right, you're going to see the small losses, right? Like, well, 3% is not a small loss, but compared to a 23.93, it is. And then Google, okay, I had a loss of 0.84%, no big deal. It's just a small loss. Okay, so those are the open daily trades, the closed daily trades, and then finally, let's go to the open weekly trades that I have. Weekly trades happen on Fridays. On my weekly trades, I make my buying and selling decisions on Friday because each bar is a week. So I did get long TLT, which is bonds. I got long on the 17th of January. Why? Well, we confluence the signals. Here you have your green order block. We rejected the order block. We also created a V1. If you'd like to learn more about V1s, V2s, go to my YouTube channel. I have a video about that. I got long here because we have the V1. I got long here because we rejected the top of the order block. I got long at 87.20. Placed my emergency stop 2 ATRs below. My end of bar stop is a close below halfway of the entry bar. Place my trailing stop level 1.5 ATRs above. Next week we went up. I don't think I hit a profit target, but it was up. Next week we went up a little bit more, not enough for a profit target. The next week on the 7th of February, we had a nice move up where I was able to take a profit target. Then we had 2 weeks where it didn't do much. Here on the 28th, we had a nice big move up in bonds, which I did take profit targets and multiple profit targets. And we did get to trailing stop level. So now I'm in trailing stop mode, which means that if I have a close below a previous bar's low, I would get out of half. This week at one point we were below the low, but it closed above, so I kept the trade. So the weekly trade here on bonds, doing pretty good, up 3.27%. Okay, let's go to DDM. Well, this has been a really big trade for me. This is double leverage Dow, and I got short here at 107.30. Why did I get short? Well, you see the red box, right? You see the red order block. This is a bearish order block. What makes it a bearish order block? You have your highest up bar close before you change market structure to the downside. On the if you get an ensuing rally, I'm looking for a rejection of the bottom of the order block. I got short here, 103.70. My emergency stop is 2 ATRs above. My end of bar stops at close below the high of the order block. Place my trailing stop level 1.5 ATRs above or below because it's short. Next week, I did hit a profit target. Next week, nothing. This week on the 21st, I hit multiple profit targets on the way down. Then we had that kind of nothing week in the middle. Then here on the 7th of March, huge multiple profit targets to the downside, where I think I hit three. I took 3 profit targets off, also at trailing stop level. And then, of course, this week, really down, hit multiple profit targets. And so now I'm at trailing stop level. I'm well below it. So in the future, if I get a close above a previous bar's high, I'm going to take off half of the shares. I did get to a 35 RSI down here. So now if I close above this 5 EMA, I will just be completely out of the trade. But this was a monster trade, up 15.64% to the downside. So I'm telling you, the combination of the deep dip buys along with the bullish and bearish order blocks are no joke. You should, learn them. You will be happy that you learned them. You can learn them from watching this channel. You can learn them by hiring me to teach you my one-on-one course. But when you're done, you're going to see these, and they're, doesn't mean they have to be profitable trades, but they are a good tool in your trading box to use. And I mean, you can see from this example, it just nailed it. So up 15.64% on the short. Last but not least, Tesla. I've been talking about Tesla for weeks on the weekly bars, and I said, look, weeks ago when it was up here, I said, look, if we get down to the 200, that would be the place to buy, but I'm not going to mess with it until, and look what it did this Friday. I got long 249.99. Why? Well, multiple reasons. One, we're in a bullish order block. You can see the green. 2, we rejected the 200-day moving average. 3, we had a golden cross a couple months ago where the 50 SMA closes over the 200 SMA. Why is that important? Well, just from my experience in trading, if you have a golden cross, which is called the 50 crossing over the 200, if you have a golden cross, the first move back to the 200 after the golden cross happens is generally a place where it tends to bounce. So a lot of confluences, right? You have the bullish order block on the weekly. You have the intra-week rejection of the 200-week moving average, and you have that happen after. This is the first time you've had a test of the 200 after the golden cross. So I did get long on Friday at the end of the market, 249.99. My end of bar stop is simply going to be a weekly close below the 200-day moving average. I have my emergency stop 2 ATRs below, and of course I put my 1.5 ATR trailing level 1.5 ATRs above, right? So that's the trade. We'll see how it works out. It would be nice if the market would bounce here, and hopefully Tesla will bounce. But next week, by Friday, if it closes under this 200-day moving average, I'm simply out of the trade. I can get back in the coming weeks if it closes back above. So review of the weekly trades, TLT up 3.27% on the bullish order block in the V1, DDM the short, bearish order block up, what does that say again? 15.64%, and the Tesla trade I just barely took, just about even. So those are the trades, everyone. I hope that was helpful for you to kind of get an idea of how I look at longs, how I look at shorts, how I look at the the combination and confluences of the signals lining up. If you have any questions about those, put them in the comment section. I'm happy to reply to those and answer your questions. All right. So right now, let's do just a few minutes on trader psychology, and then we'll look at the potential trades starting for next week. Sound good? Okay. This is from my good friend and mentor, Steve Burns. You can find Steve Burns on X at S. Joseph Burns. Great trader, great author, great coach. Worked with him for multiple years. And so when Steve says something, I listen because it's always good advice. Building a profitable trading system is not easy. No, it's not that hard, but it's not that easy. But you need a profitable trading system that tells you, in other words, you need a process. You need a profitable process to trade the markets. Staying calm and executing your signal is difficult. You can build a really good trading system, but keeping your emotions about you, staying calm, and then exiting what your rules tell you to do is difficult. Staying consistent and managing risk is even harder. Sometimes you might do it, sometimes you may not do it, but staying consistent and always following your rules is essentially what this is. Get yourself some rules, stay calm and execute the rules, be consistent with executing your rules. Managing your mind and your emotions during drawdown is the most difficult. That's right where we are now, folks, right? I'm getting signals to tell me to buy. Is it easy to buy when the market's this volatile and the news is this bad and the headlines are horrible? No. But it goes back to, I have my rules. I'm going to stay calm and execute those consistently. And even when you have huge drawdowns, like Steve says is the most difficult, you still have to do it. Managing your mind and your emotions. Your rules are in place, but can you manage your mind and your emotions to follow those rules? Is it all worth it in the end? Yes, it is. So again, get yourself a trading process that incorporates good trading rules, multiple signals, good risk to reward ratios, position sizing based upon volatility, what to do to the downside, what to do if it starts going up, right? Playing offense and defense. But it's all about getting yourself a process and following that process. Is it worth it in the end? Yes, it is. So thanks, Steve. Appreciate that. Steve has multiple books that you can buy on Amazon. Just look up Steve Burns on Amazon and read his books. Read them all. Read Moving Averages 101. I actually wrote the foreword on that book. That's a really, really good book. So you can find him on Amazon. And I use his information all the time on this channel during the psychology section because he's really good. So thank you, Steve, for that. And I hope that was helpful. Okay, let's finally get over to the stuff for next week. And I've got some good ones. And I always say this before I get into these. Listen, here on the daily time frame, I have, seven potential trades for next week. Now, theoretically, it's possible that all 7 of these could trigger at the same time. Does that mean I'm going to take 7 new entries? No. I have a rule. I only take 1 trade per day, even if I have multiple candidates to choose from. Why do I do that? Well, if all 7 of these trigger on Monday, for example, I have a methodology where I score the setup. So if one has 1 signal, but the other has 2 signals, obviously I'm going to take the one that has 2 signals. Maybe there's one that has 3, maybe that one that has 4, right? Maybe it has an under over 30 and an under over the 200. Maybe it's in an order block. Maybe it has a V1. Maybe it has bullish divergences, right? So it's a scorecard. And that forces me to take only the best trade of the day or the week if it's a weekly trade. And this is what I teach my students, how to do this. Multiple signals, risk to rewards. I like to look at higher time frames as well. You know, for example, if I have two here on the daily that have the exact same score, I'm going to look at the higher time frame. Maybe the technicals and the price action on the higher time frame would tell me, oh, this one's better than that. So, and then relative strength is also something else that I use. Is the market down, but this stock was actually up? Well, then it has more relative strength than the others. That gives it another point. And it's an important thing to do in trading, to score. If you have multiple entry signals, to score and take the best one. And again, this is what I teach in my one-on-one course. I would love to have you as a student. I'll teach you everything you know. The course is a total of 15 hours. We usually do 3-hour sessions, 5 sessions total. And I'm going to teach you everything I know, and you're going to have a skill you can use the rest of your life. Now, one-on-one it's always the best way to go about it. It's more expensive, but it's the best. Alternatively, I've been talking a lot about the deep dip buy because that's where we're at the moment. I have a great course on udemy.com where I teach you step-by-step how to trade the deep dip buy. It's very affordable. The link's in the description. It's 9.5 hours of video, and that's a good way to start. But if you'd like to learn all 7 of the different ones that I use, then that's with me on the one-on-one. So send me an email. We can get the conversation started. Okay, let's get back to Goldman Sachs. This is the first one that I'm looking at for potentially for next week. Excuse me. So Goldman Sachs was a legitimate entry on Friday. I could have taken this trade. Why? Under 200, over 200, under the 30 RSI, over the 30 RSI, under the negative third ATR channel, over the negative 30 ATR channel, and a pretty good risk to reward. I took the Dow instead of this because it had a higher score. But looking forward into the future now, what really caught my attention last night when I was going down through here is this bullish order block. You see the green box, right? The block of green, order block. Well, look, it dovetails with the 250-day moving average. I love when I have a long-term major moving average like the 200, 250, or the 300 that coincides in a bullish order block. They don't always work, but they work a lot more than they don't. Now, did we make a bottom on Goldman Sachs that's going to head up from here? It's likely. I think it's more likely than not, but it's not 100%. So it is possible that we could come down. I don't want it to come down because I have long positions, but if it does, this is the area that I think would be really excellent risk to reward ratio on Goldman Sachs. If it never comes down here, I'm just not going to touch it. But if it does, I'm going to take advantage that we are in a bullish order block and that I have some kind of rejection of the 250. I need a rejection of the 250 before I do anything, but this is a really sweet area if we come down here, but only if we come down here. So that's what I'm looking for on Goldman Sachs. MasterCard, MA, okay, same kind of a thing. Not as good as Goldman Sachs. Why? Well, look, Goldman Sachs, again, has the order block, has the 250 inside the order block. Look at MasterCard. MasterCard has a nice order block. Not saying it wouldn't be a good trade, and I would be looking for that. I would be looking for some kind of rejection at the top of the order block or the bottom of the order block. But you see how we don't have a major moving average running through the order block like we do on Goldman Sachs? That's, if I'm scoring them, Goldman Sachs has the higher score. Does that make sense? Going back to the scoring. But still, MasterCard has a legitimate order block, lowest bar closed before we change market structure to the upside. So therefore, a rejection of the high of the order block or the rejection of the low of the order block. The low is about 503.11. The high is about, 513.94. So this is potential buying area on MasterCard if it comes down here. Meta. This one is sweet. I gotta say, everybody, this, I don't know if it's going to get here, but if it does get here, what a place to buy Meta. Really. I mean, one, it's come down a ton, obviously. But two, look at this. We have an order block. We have the 200-day moving average sitting smack dab in the order block. It's pretty good, everyone. I don't know if we're going to come down here. Maybe we do, maybe we don't. But if we do, I am certainly going to consider getting long Meta. I mean, if you loved it up here, which apparently everyone did, if you love it up here, you got to really love it down here. And so this is what I'm looking for, a rejection of the 200-day moving average inside of the bullish order block. You don't get much better than that on a stock like Meta. But again, even if it triggers, it doesn't mean it has to hold. If we reject the top of the order block, or we reject the 200 and the next day it closes below the 200, I'm out. Next day, if it goes back above, I can always get back in. So I'm going to watch Meta carefully at this area. Netflix. Well, you can see here's the green order block down here between 847 and about 822. Last week we threatened to get down to this area, but this is about where it bounced. This is about where it bounced. So we bounced quite a bit from that area. So I put this on here just in case we do come down again next week hard. And if we do, a rejection of the high of this order block here at about 846 would be a good entry. Although I don't really think it's going to come down. But, you know, what do I know? I think it's unlikely, but it's possible. But if we do reject the top of the order block at 845.84, I would consider getting long. If we reject the bottom of the order block, 822.05, I would consider getting long there as well. Philip Morris. Okay, so Philip Morris has a whole different looking chart because Philip Morris is like a consumer defensive stock, right? As the market's been going down, money has been flowing in the consumer defensive stocks as a safety play. However, you see a red box here. Why the red box? Well, it's an order block. Highest up bar close on the 3rd. We broke structure to the downside. If you break structure to the downside, then if I get a rally back to the bearish order block, I want to short. This also portends some potential good things for the regular market, because if we come up here, reject, and then have a leg down, it most likely will be coming down because money is coming out of these safety stocks and going back into the regular market. Make sense? So anyway, rejection of the bottom of the order block here, 153.94 would be a potential short. What I really like is a rejection of 156.30. You can see the big down bar on the 3rd or the 4th of March, big down bar. If we can rally back up to halfway and reject halfway of that big down bar, that would be a good spot as well. If we go up again and reject the high of the order block, 158.97, I would potentially try to get short there too. But this structure change to the downside in these safety stocks kind of implies potentially, could be wrong, but this kind of implies potentially that we maybe have put a bit of a bottom in the normal market. I'm hoping, but I'm not telling you this because of hope. I'm just telling you this because the structure has changed. So that may be what that's forecasting. The Qs, the NASDAQ. Okay, so we had a legitimate entry on Qs on Friday. I didn't take it. I got long the Dow instead. But why? Well, we closed under the 300-day moving average, closed back over. That by itself is a legitimate signal. We closed under the 30 RSI, closed over the 30 RSI, also a legitimate signal. You know, that's good for the market. That signals potential low, although we could come back and backtest this 300-day moving average. So, and I think it's very likely that we could come back and backtest it just to make sure that's really holding. Next week, if we do, and I don't have other positions, next week, if we do come down, retest intraday reject or bounce at the 300, I would consider getting long there. Additionally, if we do go down further and make new lows on this move down, you do have this order block here from 461 to 447. a rejection at the high of the order block at 462 would be a really good entry price as well. Again, I hope it doesn't come down here, because if it does, then my other positions are going down. But we have to be open to this possibility. And so two potential options on the Qs would be a retest of the 300 with a good risk to reward ratio, or if we break to new lows, a rejection of the high of the order block at 461.29. Last but not least, this looks really good as well, Walmart. I remember Walmart just going up and up. I was like, are these people insane? Like, I never buy up here, right? And I felt pretty confident that when this came down, it was going to come down hard, and it did. But now that everybody hates Walmart, this is usually the type of time that you want to potentially look at entering if you get the right signal. You see the green order block all the way back here from the 29th of October, 2024. This order block happened. And was it, when it changed market structure to the upside, was it right? Yeah, it sure was. But look, we're getting right back to it again. So look what happens. We are getting close to the bullish order block. And in addition, you got that big, fat 200-day moving average right there. We haven't tested it yet, but that is a nice area to take a trade. But I'm waiting for a rejection of the top of the order block at about 82.79, or a rejection of the 200-day moving average, which is 82.19, so not far away, or a rejection of the bottom of the order block, 81.35. So this, I think, is a really good opportunity if you wanted to get into Walmart. I mean, clearly it's sold off a ton, right? You're buying it at a better price here than up here, but from a technical standpoint, you've got a nice confluence of signals right here. And this may just take off and I'll miss the whole trade. That's okay. But if it does come down, reject the high of the order block or reject the 200-day moving average, I very likely would consider getting in. And there's many of those, right? Walmart's that I just went over, Meta, same thing. We have the bullish order block and the 200-day, and Goldman Sachs, where you have the order block, but you have the 250 instead of the 300. And what it did on Friday was also a good sign. But again, if it comes down into the bullish order block and rejects the 250, I would consider that. So those are the dailies. Let's do the weeklies. And I apologize that this podcast is so long, everyone, but there's just a lot of things going on here, a lot of positions, but it's a good learning experience. Okay, look at Anheuser-Busch. Well, you see the red box up here? That's the bearish order block. Highest up bar close before we just sell off to nothing. Nobody wanted it. Now everyone wants it, but I'm looking for a short if next week we reject the bottom of the order block there at about 65.09. So it's still a few dollars away from that potential. But again, this is a safety stock. If the safety stocks start rejecting these bearish order blocks, that's could be good news for the other market. Home Depot. Okay, again, weekly, we have the bullish order block, we have the 200-week moving average. If we come down, reject the high of the order block, I potentially get long Home Depot. If we come down lower, reject the 200-week moving average inside the bullish order block, I would certainly be interested in potentially taking that trade there. Or last but not least, a rejection of the low of the order block at 316.48. Russell 2000, IWM. Super legitimate signal on Friday. I didn't take the signal, but it is super legitimate because why? We rejected the 200-week inside and we rejected the top of the order block, right? I took Tesla instead, but next week, what I'm looking for, because I'm long a bunch of stuff already, right? And so if I get a trade on IWM, I really want a really good entry. I could have taken this trade, but I didn't. Here's the 250-week moving average in the order block. You can see interweek, that's about almost exactly where we bounced. So if I'm really interested in getting into IWM, it will be only because it was a legitimate signal on Friday already. But the only way I would get into IWM is if we reject the lower moving average, which is the 250-day moving inside the order block. And that right now is about 196.68. Microsoft. Microsoft, I mean, obviously, with the rest of tech, has sold off like crazy, but there is a nice weekly order block coming here at 372.61. That's still 16 points below. I don't know if it's going to test that, but if it does, I would consider getting long with the rejection of the top of the order block, 372.61, or a rejection of the low, 363.30. PayPal, PYPL. You see the order block here from 60.78 to 57.15. Lowest bar close before we change market structure to the upside. Don't know if it's going to get there. You know, it's really going to have to go down a lot to reject the top of that order block at 60.92, but it's possible. I mean, it's going to have to go down another $8, but if we have another big sell-off, it's a potential, but that's the only place I want to buy PayPal. If it gets there, I'll consider it. If it doesn't get there, I'm not going to. And that's one of the main advantages you have as a retail trader is you can sit on your hands, you can be patient, you can wait for the perfect pitch, right? Or wait for the perfect technical setup. And, you know, if somebody said, okay, you have to buy PayPal, but you can choose where you want to buy it. Okay. If it rejects 30.66, I consider buying it. But that's all. USO is oil. Okay. Well, again, here you have the bullish order block. You have the 200-week moving average inside the order block. Both of those happening together would be great. So a rejection of the 200-week moving average would also, inside the order block, I would certainly consider that. The 200 is at 69.12. We are at 72.28, so we're still a few dollars, a little bit less than a few dollars below the entry price right now. We're that, you know, we're 69.12 and we're at 72.28. So it would have to go down like $2.50 in order to be a legitimate entry. But a rejection to the 200-week moving average would be great because it resides in the order block. Last but not least, everyone, utilities, XLU. Why am I interested in this? Well, I guess I should make this the right color to begin with. Okay, bearish order block. Why? Well, we have a high here, break structure to the downside. If you break structure to the downside, you want to short the rallies. Where would be the where do you want to short? The low of the high. Here's the order block. The low. You want to short the low of the highest order block. And so the low of this particular bar is 83.41. The high, I'm sorry, the low is 81, the high is 83.41. So anywhere between 81 and 84.31, the red box is the order block. Why am I looking for a short here again? Because we change market structure to the downside. You have your highest up bar close before you change market structure to the downside. Therefore, on any rallies in the future, a rejection of the top or the bottom of the order block is the shortable area. So, whew, this is a long podcast, and if you've made it to the end, I really appreciate it. I hope this was helpful, everyone. We went over a lot of material today, a lot of trades. It's an interesting time in the market, everyone. But, you know, if I can be helpful to you in any way, answering questions, please put them in the chat. Love to do that. If I can help you with one-on-one lessons, please send me an email. Love to have you as a student. If you'd like to take my online course at udemy.com, that link's in the description. But get yourself a process, follow the process. Don't panic. We are coming into some legitimate areas, but you have to adhere to your rules because those levels may not hold. But I appreciate you being here. I hope you found it helpful. Like I said, if it was, if you could hit the thumbs up button, I would appreciate it. If you could try to go out and do something nice for someone today, you know, I always try to mention that on the podcast. Try to go out and do one nice thing for another human being. Really would, you know, it really may make their day, and you never know how much they would appreciate it. If you could try to go out and do something nice for an animal today, they would appreciate it too. I was raised with many, many animals. They appreciate acts of kindness just like we do. So thank you so much. I hope you have a good weekend, everyone. Hope you can relax, spend time with your family. And God willing, I will see you next week. and we'll see what's happening with these crazy markets. So on the way out here, I have to run the U.S. legal disclaimer. All right, everyone, take care. We'll talk to you soon. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.